Money has an incredible way of moving itself from the inpatient to the patient. If you can find folks who are really focused on the long term, hook them up with capital that is also flexible enough to focus on the long term, then you've got a great fit.
Welcome to The Edge for Tomorrow. I'm your host, Rose Reed. Today, we're joined by Maury McCoy. And the question we're asking is, who actually decides which emerging managers get funded? And why do some of the best strategies stay undiscovered for years? Well, Maury McCoy has spent more than 2 decades connecting high conviction managers in inefficient markets with endowments, foundations, and family offices. So if you want to understand how real capital allocators think, this is the perspective that you want. Maury, thank you so much for being here.
Yeah, glad to be here. Appreciate it.
Was there a catalyst event or was there a job or a mentor that got you into not what you do, but it's almost like a calling that you've answered?
It's interesting. I originally, my background is quite a bit diverse. I started off as a 3D animator and a video game producer and really loved those careers. But they were, oh my gosh, the hours were insane as a video game producer. And I moved down to Austin, Texas, and I had a buddy who was starting an investment advisory firm. And I'd always wanted to kind of get into the investment business. I grew up in Omaha, Nebraska, so raised on Warren Buffett. My parents, put newspaper clippings on my desk since I was like in third grade of like, be like this guy. And so yeah, so he was a brilliant guy, really smart, and I was off producing websites and doing all sorts of things. And he's like, hey, why don't you come over to the financial world? Like, I think you'd be a great fit here. We love talking finance. And yeah, what he did, he was a brilliant investor. But the problem with being one of these hedge fund managers is you've got to pick stocks, you've got to run the business, you've got to run compliance, and marketing isn't typically their forte. And I got along great. He trusted me. We'd been friends forever. And he's like, you're outgoing, you're an extrovert, and those weren't necessarily his things. He had better uses for his time, and he was like, "Hey, maybe you can help me out, and we can work together." And it finally allowed me to crack into finance because up until that, um, the investment world is I don't want to say it's seedy, but there's a lot of bad products out there, and the ways to crack into the industry aren't necessarily, at the top with the best investors. And so I had a chance to really, from the get-go, reach out to institutions and endowments and foundations and these really smart investors who were doing things the right way and hook them up with managers who were doing things the right way. Yeah.
So tell me, like, what do you think is the biggest misconception of your role?
Just that people will go out and hire a marketer and be like, oh, yeah, I've had people call me and say, okay, when can you start? And how soon will it be before I raise, $10 million, $20 million, whatever. And it just does not work like that. These types of things are a partnership. It's as much the marketer finding a good fit for them as it is the investment manager just going out and hiring someone. I can't tell you how many managers I turned down. I've got dozens and dozens of managers, I would say, that I would call on kind of like the farm team that I read their quarterly letters and I track them. And a lot of them have real potential, but they're not quite ready for prime time yet. And, especially at the highest levels of raising money. That's a big misconception. Also, the other big misconception is a lot of people are like, I don't need to hire a marketer. I'll just put up great numbers and the world will beat a path to my door. It's a long process. Most of the bigger institutions are slow to hire, slow to fire. And that's great because when you land them, you have a long-term relationship. And if things don't go well, they're not going to fire you for having a bad quarter. If anything, the best ones might allocate more because, hey, they know you know what you're doing, and there's probably just a temporary disconnect.
So why don't you walk me through how you look at this landscape? You've been doing what you've been doing for over 2 decades. How would you
Yeah,
place yourself and give me the landscape within this financial system?
it's interesting. There's a lot of layers and a lot of middlemen, to be honest with you, and I'm probably just another one of them. Research analyst is his job title because that's the most important thing. So anytime these folks can, farm stuff out to guys like me just to make their life easier, that works pretty well. But yeah, so what I do is I'm basically a relationship builder. I reach out to folks who, endowments, foundations, people doing really cool things in the world, funding colleges and building libraries in Africa and all sorts of neat things. And so I reach out to them, build long-term relationships with them, and try and find out what they're looking for and what they're interested in. And so that makes it easier. Endowments and foundations know that, hey, if we're looking for examples, small cap values, small micro cap managers, Maury is a guy who knows that space really well. And so, yeah, it makes it a little bit easier in that regard. And then also, too, having had some success with previous managers, that really opens the door because it is all about building trust with these people.
And do you have like a rubric or a gut check that helps you identify what's the biggest differentiator between a good manager and a great one?
Performance and assets under management and these things that are kind of table stakes. You have to ideally have a 3-year track record and ideally be managing enough money that it matters and that it counts. But really, it does come back to, people. And I, the character I found matters more and more the more I get into this. There are a lot of really talented, amazing investment managers, but communication skills are vital. It's hard to build a rapport and trust with someone if you can't communicate.
Tell me a little bit about that process and that edge and how you identify that.
Yeah, well, I mean, it starts off with just structurally putting yourself in a position to succeed. And like if you're focused on small cap stocks, there are thousands of these opportunities down there. And for the most part, the big guys are ignoring them. So you've got this huge playing field, so more opportunities and less competition. Sometimes the opportunity set can be just as important as your skill set. Concentrated, I like managers who invest in their best ideas. If you're putting money into your 30th best idea, why not put more money in your first or second best idea? It's about conviction. And so having extra information in an area that's void of information and the ability to place high conviction bets when you know what's going on and the rest of the world doesn't. It's interesting. Before the call, we were kind of talking about how indexes and quants have kind of taken over the world. And that's absolutely true. Like 80%, it's estimated, of trades are made by algorithms. Indexes just keep getting money, and the big companies in the indexes just keep getting more money, and that snowballs. But trees don't grow up to the sky. It's at some point valuations matter and free cash flow matters in these things. And so
Yeah.
you want people who are looking at these stocks and can figure out what's going on. And ideally, you want managers who aren't necessarily looking at the numbers. They're looking beyond the numbers. They're looking to see what management's doing, what changes are happening at the business that you just can't get from looking at a Bloomberg terminal. Yeah.
Are you able to talk me through a case study, maybe a really interesting bet that you've seen?
Yeah. I would say it's interesting. Some of the most fascinating investments are incredibly boring.
Yeah, yeah.
Everyone wants to do AI, everyone wants to do, technology. And sometimes the best investments are, management companies that are taking over a business that's been struggling and they put it on the right track. And then all of a sudden it starts printing money. But there are a lot of cases where companies are just misunderstood or bad optically in the financials. But if you really dig into it and you talk to management and talk to suppliers and all of these people, there's like a real simple situation is there's a company right now, one of my managers is invested in, and they do drug manufacturing and they've built out all of this manufacturing capability. And if you're just looking at the numbers, it looks like they're burning through money and they're not making any. If you're just looking at the numbers and if a quant strategy is looking like at a strategy like this, it's seeing a company that's losing money. It's not attractive. But if you can just look out far enough ahead, I think that's really important is to think long term. Oh my gosh, it is amazing how short term people are thinking these days. You have meme stocks and all these multi-manager pod shops that are betting on, if the earnings will hit this quarter. And to institutional investors, they're pools of capital that are there for infinity. I mean, Harvard's not going anywhere anytime soon. Money has an incredible way of moving itself from the inpatient to the patient. If you can find folks who are really focused on the long term, hook them up with capital that is also flexible enough to focus on the long term, then you've got a great fit.
When you look at the momentum right now, what do you think small managers and small caps have as an advantage? If you could give like an example of what's large and what's small.
Yeah, yeah. So large cap growth, you're looking at the Mag 7 companies like Amazon and Nvidia and yeah, Google. And these companies have been printing money. And don't get me wrong, they're making a lot of money and they're responsible for about 30% of the, revenue of the S&P 500. So they've earned their place. But a lot of them are really priced to perfection, and you're paying
Mm,
as much for these companies as if they had already had 10 years of great results in the bag. And, things happen, disruption happens. A lot of things have to go right for those companies to kind of deserve the valuations they're at. And meanwhile, in the small cap space, you have all these companies that no one are looking at.
mm.
And they just are ignored, and a lot of them are, printing money themselves, but maybe just in a little smaller market. Some of them are regional, not a lot of small and micro caps are international, so they're not influenced necessarily by, those type of trends. But yeah, so they make money, and sometimes to get noticed, they just buy back their own stock because they know it's cheap. But at some point, value outs itself, and if something's making a lot of money, but yeah, I would say small cap value in particular is cheap just because there's this huge disparity in valuations. You're paying very richly to get the biggest companies and some of these high flyers, whereas there are things in the bargain basement that are on the other side of the spectrum. Yeah.
There's some really smart investments to make that don't cost a premium because they might be overlooked for some reason.
Yeah, totally overlooked. And when you look at the pools of capital, you look at, some of these endowments, foundations, University of Texas, Harvard folks, they have tens of billions of dollars. They're not going looking in the bargain bin small microcap stocks. They just have too much money. They would crush them, to be honest with you, with the weight of the assets they kind of throw around. So you can find these smaller managers who are kind of taking advantage of these opportunities. And they're a great fit for smaller endowments, foundations, family offices in particular, like these types of folks. And so, yeah, it's there are definitely opportunities out there. And in the current environment, it's interesting. Index funds and quant funds have been all the rage, and large caps have been all the rage. But at some point, everything is cyclical, and the rumors of value investing being dead come out every decade or so, and then value goes on to have an incredible run, and growth takes a hit. We've all lived through 2000 and 2008. And so, one of the things when I look at a manager is ideally I'd love to see how they handle the downturn. Just because everyone talks a good game about, hey, I invest in stocks that only go up and they're downside protected and they have all this money on the balance sheet. But to be able to actually see that they've navigated a bad environment, most of the upstart managers these days have only seen good times. If you've been investing since 2008, it is risk on and nothing can go wrong. And if I'm looking for a manager, I would love to see them make mistakes with someone else's money and learn those lessons before they do it with my clients' money.
When there are people who have their blinders on to what the risks actually are, how are you separating what you identify as the biggest risk and the biggest potential reward over the next 5 years?
I think there's a lot of that going on in the investment industry, private equity in particular. There has been this rush, and private equity are companies that are smaller and they're not traded on the stock market. And people go out and buy them and run them with the hopes of eventually selling them to other people for a higher profit or making them public and putting them on the stock market. And it's been all the rage. Some endowments have been up to 40% invested in private equity. A lot of people are overexposed to that, and I would say that the quality of managers later in the game isn't quite as good. And anytime you have a ton of money chasing a limited number of great opportunities, then the quality goes down. And so that I would say is a risk. As I mentioned earlier, the short-term thinking, a lot of these pod shops, they're charging their own fees, and then there's these overarching companies that invest in all the other managers and they're charging a fee on top of that. And then the marketing guy who, places them with you charges his fee. And by the time it gets to the investors, there's so many hands in the pot that, any investment returns are typically going to someone else. Some of them can be the hot hand for a while, but in general, I've found short-term thinking tends to be a tough way to make money in this industry. There's some quants and stuff who have figured it out, the guys with the big computers, and I'm sure AI is helping in that regard. But at the end of the day, when they all get the same models and do the same thing, any sort of advantage that someone has gets arbitraged away pretty quick. You want a manager who has an edge that's repeatable and that you can identify that they'll be able to do it again. If someone got lucky and invested in Netflix and they come to me or Amazon and I look at their performance and I see one stock has driven their whole performance, but I look at the rest of their portfolio and it's like everything's kind of middling. Yeah, you get credit for picking that great stock. But I'm not sure that's a repeatable edge. I'm not sure you can do that again. And so I like to see managers where I can look across their portfolio and see that, they've had more hits than misses and that the misses haven't been too bad. Or if they have been bad, they've been a very tiny portion of the portfolio, so they've sized things appropriately. Because, sometimes you take a swing at things and sometimes it doesn't work out. But there's a difference between people investing in stocks to try and make a reasonable return and people who are trying to do venture capital like stuff where one stock is 100 bagger and the rest of the portfolio is zeros. Those don't institutional investors like that, but that's a separate bucket. And when you're investing in public companies, that's not typically what they're looking for.
What's one trend or signal that you are watching closely that you think others may not be paying such close attention to?
Interesting. I would say this notion that these private equity funds are having a hard time returning money to their investors. And they're having a hard time finding people to sell these to. So, while they mark the price at this, it's kind of fictional until you actually sell it. And the same with the house price. And so I think a lot of these folks, you see some of the bigger endowments kind of trying to dump their private equity holdings a bit. And that's usually the canary in the coal mine that things are switching. What the smart guys do first, the fools do later, as they said. And so there is some of that going on. Illiquidity, it's one of those things where people have a lot of their huge advantage of these endowments and foundations is that they don't need money for a long time, so they can make long-term investments. But there are times when liquidity matters, and when things go south, that's one of those times. And we saw it in 2008. Endowments and foundations kind of got crushed and had a lot of problems trying to come up with the money that they needed to run their colleges and things like that. And so we're seeing that even a little bit right now, where they're having some struggles trying to make ends meet there. But I would say that's the big thing. Private equity has been this huge push lately, and now the latest thing is private credit, which is basically people giving loans to the private equity companies. So it just keeps getting passed down. But at some point, what you want are just great companies that generate cash flows, and you want to be able to find managers who can find those kinds of things.
And where can people find you?
I am at mccoy-associates.com. My name is Maury McCoy, and I'm there everywhere on Twitter, on LinkedIn. For the most part, I'm really the only Maury McCoy out there. So yeah, if you look for me, you'll probably see some interviews like this, and I'm pretty easy to find.
I think just to end with, I do find it full circle that you had such an admiration for Warren Buffett, who it seems that you've really kind of stepped into that legacy of caring for the long-term edge and looking at matching relationships and looking for trust, looking for integrity, looking for character, and coming up with your own rubric to like match make that.
Yeah, no, it's funny. I get a lot of pitch books, and if you don't mention, Warren Buffett or Charlie Munger at least once or twice, then you kind of lose your value cred in the industry. So, yeah, being from Omaha, I get to make more Warren Buffett quotes than most. But yeah, it's no, he was a huge influence, and he knows what he's doing. And you know, to that point, every few years, people say, "Oh, he's lost his edge, he's lost his touch." We need to invest in this fancy thing or the other new shiny object. And the old guy seems to know what he's doing. He keeps at it and keeps putting up great returns.
Well, thank you so much for your time today.
Yeah, hey, thanks so much. I appreciate you having me on.